So, I think we can start this afternoon. Good afternoon to everybody, and welcome to this session. This session is dedicated to the continuation of what we started to see this morning about the capital budgeting of a project finance deal. You will certainly remember that we started from the first point, which cash flows to use. We started by analyzing the concept of free cash flow, and we said that basically there isn't much difference between the free cash flow for a corporate finance setting and a free cash flow in a project finance setting, but we have seen that there is a strong separation between the construction phase and the operating phase, in the sense that during the construction phase we have only cash flows dedicated to the CapEx expenditures for the setup of the transaction, while in the operating phase we have only the cash flows that the deal will be able to generate. So there is a clear-cut separation between the two phases. Then we started working on the concept of capital expenditure, because we said that in fact talking about capital expenditure means anything in project finance. And we split the cost of the investment into its basic components. The direct investments represented by the cost of the EPC contract, the cost for land, the cost for development costs, and the cost for owner's costs. So essentially all the authorization, licenses and permits that are needed in order to carry out the project. While indirect investment that were a crucial part of our budget were represented by the value-added tax during construction, because the special purpose vehicle is not able to offset the credit for VAT with debt, at least for all the years of construction. The capitalized interest, because during the construction I cannot pay interest on the used amount of money, and the capitalized fees, because I can't pay the commitment fee during construction, and so I have to capitalize everything until the end of construction. This is actually what we call total cost of investment. What I must simply add to this picture is that since we are trying to evaluate what will happen in the future, we cannot be exactly sure that this is actually the amount of money that will be necessary, because there can be some unforeseen event that can increase the amount of money that is necessary. That's why in the balance sheet of the SPV is included also a sort of further item in the cost of construction whose basic scope is to cover the so-called contingencies. So anything that could increase the value that you must spend due to unforeseen events. For example, a permit doesn't arrive at due time and you have to spend more money than expected. So the final item that is included in the balance sheet of the special purpose vehicle is the value of contingencies that is included for the sake of prudence inside the balance sheet. So contingencies. Usually 5% to 10% of the total investment cost. The idea is the possibility to fund additional 5% to 10% of the cost of the investment based on possible unexpected events. Right? Good. So this is something I wanted to tell you about the capital expenditure during construction. On the left-hand side, so we have the cost for our facility, including all the additional items. On the right-hand side, here, we have to put in place the different form of financing that are necessary in order to finance this big amount of money. And essentially, here we don't have any particular difference compared to a standard corporate finance setting. Because the basic sources of funds that we will analyze later on during our course are essentially, first of all, the amount of debt that is provided by banks. And we have already seen that this debt is a syndicate loan. The second source of funding is represented by pure equity that is provided by sponsors, and so a part of this funding will be provided by sponsor in the form of pure equity. And third possibility, and we will see why this third possibility is very often used in project finance, sponsors can opt for a rather different alternative in terms of funding. I can provide pure equity, so I become a shareholder of the special purpose vehicle, and I will get dividends from the special purpose vehicle, or I can provide some funding in the form of subordinated loan or subordinated debt. So something that is between the pure equity and the pure senior debt. It is a subordinated loan. Subordinated loans. Usually provided by the project sponsors. The idea is that the equity holders of the vehicle usually provide this amount of money, part in equity, part subordination, and the pool of banks provide essentially this amount of debt, being the ratio of debt. This is a senior debt. I mean a debt that is paid before any other source of funding. So the proportion of debt senior plus debt subordination over equity defines the debt to equity ratio that we will use in our project finance. Right? Just let me spend two quick words about the debt. I will return on the topic later on, but just to complete the picture, and then we can move to the cash flows in the operational phase. When talking about debt in project financing means anything, because we must exactly define which kind of debt is provided by banks to the special purpose vehicle. Essentially, the idea is there is a part of the debt that will be used in the proportion that has been set in terms of debt and equity to finance essentially all the items but the value added tax. So essentially a large proportion of this debt will be dedicated, based on the proportion between debt and equity, to finance all the direct investments plus the indirect investment except the value added tax. This portion of debt is called usually base facility. So it is the most important part of the loan, base facility. So base facility aims at covering essentially the direct investments plus indirect investments, excluding only the value added tax credit. So base facility, all but value added tax. Value added tax is financed with a special line of credit that is provided exactly to match the credit that the special purpose vehicle has toward the value added tax office, and is matched exactly with one portion of the loan that is especially dedicated to fund this particular item. And that's why very often the syndicate provides you, in addition to the base facility, a second tranche of the loan whose name is exactly that loan or that facility, whose basic scope is essentially to finance the VAT need. So you have a base facility that covers the most important items of your project. You have a special line of credit that is dedicated to cover the needs of the value added tax, plus you have contingencies. And Until contingencies are not, have not emerged, so you don't have contingencies, you will not see contingencies in the balance sheet. If the value of the project is 100 and the cost of project is exactly based on budget, you will never see contingencies, right? You will start seeing contingencies into the balance sheet only when the cost is higher than the original amount. For this reason, if and only if contingencies will arise during the construction phase, we will have to cover also these contingencies, not with the base facility that was dedicated to the financing of the original cost of direct investment plus indirect investment, but a special loan whose name is exactly standby loan. I mean, a loan that is there, it is standby until some contingencies take place. And in that case, the standby facility will be used. If no contingencies emerge, the contingency will not emerge, will not increase the cost, and the standby facility will expire unused. Okay? Right? So, we have a base facility, a value-added tax loan, plus a standby facility. Standby loan. Whose basic scope is to finance, essentially, the emergence, the eventual emergence of contingencies. Okay? In terms of spread, in terms of interest rate that will be charged to the special purpose vehicle by the bank syndicate, in your opinion, which of the three credit lines is the riskier of the three? Which is the riskier of the three? The standby, obviously, because if some contingency emerges, this means that something is not moving according to the budget. And so it is why standby loan is paid with a higher level of interest rate compared to the other two, right? Second, in terms of cost, is the base facility because it is the facility that must take into consideration the larger proportion of funds. And so, in terms of interest rate, this is rather expensive, while the value-added tax is the cheapest of the three, for a simple reason. Once the project starts performing, once the project has been constructed, and so the highway start operation, anytime I invoice my customer, I will collect cash from VAT. And this VAT will be immediately used to repay the loan. So that is less risky. It is less risky than the other two. Okay? And if your plant and if your facility is performing particularly well, you will recover the value-added taxes in a very short period of time. Okay? And so, it is expensive, but it is the least expensive of all the three. So, a high cost for the standby, a rather expensive cost for the base facility, a lower level of interest rate for the VAT. It is important to do this, otherwise I would pay an overall amount of high interest rate for all the loan, and it is not fair. Okay? Sufficiently clear for you? Good. One more remark about the debt, and then we can move to the cash flows during operations. Banks are guaranteed in terms of reimbursement by what? So you have lent me money in terms of base, in terms of VAT, in terms of standby loan. Which is the most important source of repayment for you? It is very easy. Tell me, which is the basic source of repayment during the operational phase? The cash flows coming from the project, the free cash flow. We will see in a moment. But in addition to free cash flow, banks, in order to provide these debts to the special purpose vehicle, require, of course, cash flows, and that's obvious, plus what is called the security package. So the loan is guaranteed by something else or over the amount of cash flows. So when debt is provided to the special purpose vehicle, the special purpose vehicle will pay the loan basically with cash flows, but banks want something more. They want more guarantee, more than cash flows. And these guarantees are represented by the so-called security package. This is a very specific feature of project finance, because in a standard corporate finance loan, you can be either a senior unsecured lender, I mean, I lend you money but I have any kind of guarantee on your balance sheet, or I can be a guaranteed lender, and so I am a secured lender. I have some form of security on your assets. In project finance, there isn't distinction between secured lenders and unsecured lenders, because everything that is inside the balance sheet of the special purpose vehicle is a full security for lenders. It is collateral for lenders, right? So a standard security package makes all these creditors secured creditors, because all the assets of the special purpose vehicle is a full security, is a full collateral for the debt providers. So you don't have secured lenders and unsecured lenders. You have only secured lenders. The problem is secured with what? Okay? What I can give to my creditors as a security? First of all, I have an highway. I create a mortgage, for Italians an ipoteca, on the facility. And if the facility is not performing, I have the right to take over the facility as a bank lender. Okay? So the first leg of the security package is the mortgage on all the assets, the fixed assets of the special purpose vehicle. Mortgage on fixed assets. In most part of legislation, I know that here I have students of different nationalities, the law usually states that if you are a secured lender with a mortgage and your borrower doesn't pay, you as a creditor have the right to take over the security and sell it in order to recover your money, right? This happens also in project finance. You have a power plant, you have a piece of real estate, you have an hospital. You have the right, if the borrower doesn't pay you, to take over this guarantee and, as a bank, do whatever you want. Okay? You can restructure, you can sell the facility, you can sell the plant, you can find other subjects in order to recover your money. Right? So, first of all, I have mortgage on all the fixed assets. Everything is given as a security to the debt providers. Second guarantee I provide to my lenders. I have mortgage on fixed assets, and in order to understand the second component of the security package, take into consideration this exhibit. You know that the special purpose vehicle receives money from a pool of banks. You know this already. And the special purpose vehicle is receiving money from project sponsors who provides equity. Right? Now, banks not only require the mortgage on the fixed assets of the special purpose vehicle, but they also ask sponsors who retain the shares in the special purpose vehicle to provide to banks, in Italian il pegno, in English the pledge, on the SPV shares. So you as a shareholder must give me the right to write on your shares my pledge right. Okay? So banks receive a guarantee represented by mortgage on fixed assets. If you don't pay me, I can take over the assets and sell them. Plus, I receive the pledge on the shares of the SPV, on SPV shares. This is particularly important for us because, again, most part of legislations state that when a pledge is written on securities, and in this case on shares, all the rights pertaining to that share stays again on the original subject. So the sponsors will collect dividend, will have the possibility to carry out the project, but there is one right that is transferred from the sponsor to banks, and it is the voting right. So when you set up a pledge on shares, all the rights of the shares remains on the sponsors, but the voting right that is shifted from the sponsors to lenders. Okay? So when you set up a pledge on the SPV shares, the voting right passes to the banks. Why is it important to give this possibility to banks? It is very easy. When things move, just one moment. Okay, when things move very well, there is no need for banks to vote in the general meeting of the special purpose vehicle because they don't have the capacity, the ability to vote regarding industrial decisions. They are banks. Okay? The problem becomes crucial where things are not going well. Because if things are not going well, I want to take over the control of the vehicle. Because the vehicle controls everything in project finance. And so if I have to restructure a deal, the first thing I must do is, first of all, I take over the fixed assets. And so fixed assets are mine. Second, I take over the pledge. And so the voting right is mine. And so I can decide whatever I want in order to restructure the loan and restructure the facility. This is the reason why they ask for the pledge. It is not an aggressive reason. It is a pure defensive reason. I want to be defended against the possibility not to be able to control the vehicle if things are not moving well. I don't know if it is clear for you. You as a bank want to control everything of the special purpose vehicle. The assets, the voting rights, and what the special purpose vehicle has. Okay? There was one question over there, and there is a question here. Over there, question? Okay, super. So the concept is, in a standard corporate finance setting, you ask for security in order to reinforce your right. You don't pay me, I take the security and I sell it. In project finance, the reason to set up this form of security is a pure defense against an unexpected event. Okay? Question?
If there is a change, for example, in the whole project, the SPV must decide if this change must be approved or not approved. How can the banks make this decision, and how can the sponsor decide to go on if this change in the project can be to...
You are talking about, yes, you are talking about change in the project. Remember that in project finance, this is not possible. Project finance is a very rigid structure. At the beginning you said that the project is the build-up of a toll road of a certain length, with a certain path, with certain costs. You cannot change during the life your original project. Because everything we are doing so far is exactly to make this transaction extremely rigid. And in fact, sponsors cannot do nothing but what has been originally agreed with lenders.
Even if the change is exogenous, I mean, it doesn't depend on the sponsor. For example, the state makes a new law that makes your project must be modified.
Yes. This is another interesting question. He's saying, but Professor, suppose that the government is changing the rules, okay? And so sponsors, who are the shareholders of the special purpose vehicle, could decide in all freedom to enter the general meeting of the special purpose vehicle and say, do you know the news? I will stop the project. They can do that because they are the shareholders. If I do not allow banks to take over the control and say, no sponsor, it is not fair to stop the project, I will vote into the general meeting and say, you will not stop the project, you will provide more equity, and I'm willing to provide more debt, but in order to continue the project, at least in a different form than expected. And this is a guarantee for you in order to recover your money. I don't know if it is right. Sufficiently clear? If you don't set up a pledge, you are at stake. You are stuck there because sponsors can decide whatever they want. The only way to control sponsors when things are not moving well is to take over the voting right. And you can do this with the pledge on the SPV shares. Okay? So, second component is the pledge on SPV shares. The third component of the security package is that the debt will include a very detailed set of, if you want, compulsory behavior. I mean, the debt that the banks will provide, the syndicate of banks will provide to the special purpose vehicle will include a particularly detailed set of behaviors that the special purpose vehicle must follow. Do something, not do something else. This set of rules is called set of covenants. Okay? I don't know how many of you know what a covenant is. How many of you? Please, raise your hands. Okay, more or less. Essentially, covenants are not security from the law point of view, but they are a way to monitor the behavior of the special purpose vehicle. Essentially, the loan will include a section, project covenants, according to which lenders will ask the special purpose vehicle to do something or not to do something. And if the covenant is not respected, ideally, the special purpose vehicle can be declared bankrupt on demand of the shareholders, of the banks. So, covenants can require to the special purpose vehicle to follow a positive behavior, so to do something, but covenants can also state not to do something. In the first case, we are talking about positive covenants. In the second, negative covenants. The list is very long. You will see one possible list in your handbook, but just suffice to say that sometimes you can have also 150, 160 covenants, stating in a very detailed way what can be done and what cannot be done by the special purpose vehicle. An example of the first one and an example of the second one. Obligation to do something, otherwise you will get bankrupt. You will be declared bankrupt by banks. Suppose that the banks want to make an inspection on the site where the construction is taking place, because they want to control that things are moving correctly. And you block the access to the technical advisor of banks. You must allow the technical advisor to access the site. Otherwise, you can be declared bankrupt. Okay? So, one of the possible positive covenants is to allow inspections. Second, more paradox. It is a strange paradox. Suppose that the special purpose vehicle that is governed by the shareholders under normal circumstances do not keep regular bookkeeping. I don't record costs, revenues, assets and liabilities. I do not keep bookkeeping. This is bad news for lenders, because if you don't keep bookkeeping, you can be suited by the law in order to, false communications or allegations toward not properly conducting bookkeeping. This is bad news, and you have to avoid it. So one covenant will be, you must keep regular bookkeeping, and you must prepare regular tax returns. Otherwise, there is a fiscal risk. You don't present tax returns, and the fiscal administration can ask you for damage. Okay? So, regular bookkeeping. Regular bookkeeping. An example of a negative covenant. What I cannot do. One example could be, one day, the sponsors decide, for example, to sell the assets to a third party. For example, I have Eurotunnel, we have a consortium of sponsors, and one day they decide to sell Eurotunnel to a third party. They can do that, right? But you can't do that actually, because the sale of assets can create some problems to your project. And so, one negative covenant is not to sell the assets of the project to third parties. Not to sell assets. The second, but I could continue with as many covenants as possible. The second possibility could be, suppose that my plant needs a certain number of spare parts, pezzi di ricambio per gli italiani, because spare parts are important in order to keep in good shape my plant. If for any reason the sponsors do not invest too much in order to keep the inventories at a certain level, this can create some problems to the project. And so one negative covenant is, do not reduce the level of inventory spare parts below a certain threshold. Okay? So minimum level of inventories, for example. Minimum level of inventories. And we could go on. But essentially the idea is, if the covenant is breached, is broken, if you don't respect, if you are not compliant with the covenant, you can be declared bankrupt. Okay? So as long as you are compliant with covenants, nothing serious. Everything is going on very smoothly. But if you break one of the contract, one of the covenants included in the contract, you get bankrupt. You can be declared bankrupt. You can be. This is a discretion of banks. The banks can decide if they want to hit you very hard to declare you bankrupt. And if you are declared bankrupt, all the money that is being lent by banks must be returned back to the banks. And this is certainly bad news. Okay? Sufficiently clear for you? Mortgage on fixed assets, pledge on the SPV shares, project covenants. There is a third family of covenants, but I will explain you in a moment, and they are called financial covenants. They are represented by financial ratios, essentially, that are important for banks in order to monitor the performance of the project. So, we will ask the special purpose vehicle to do something, not to do something, and we will include a third family of covenants, whose name is financial covenants. These financial covenants are often known with their technical name, and I will explain you two of these covenants, two of the most widely used in project finance, Inertial covenants are called very often with the term cover ratios. Cover ratios. The idea here is to set these cover ratios at a certain level and ask the special purpose vehicle to keep these cover ratios at a level that is at or above the minimum level fixed. So what is asked essentially is the definition of these cover ratios, the definition of the minimum threshold for these cover ratios, and the request to the special purpose vehicle to be in any year of the life at or above that minimum level. We will see in a moment what these cover ratios are and how they are calculated. Okay? So overall, just to complete the picture, we have seen the cost of capex, the sources of cash that are coming from three different sources: debt, equity, and subordinated loans. We have seen that debt is guaranteed, always, mortgage, covenants, and pledge. Any question about this? Everything is clear? Super. Good. Now, we have seen and we have analyzed the first part of the life of the project, where the project absorbs only cash, but is not able to generate anything. Now we must shift to the second part of the problem, the free cash flow during operation, because it is from the cash flow from operation that I can get money in order to repay the money that I got from lenders, equity holders, and subordinated lenders. Suppose, to help me building the situation of a project that is essentially a real estate complex of buildings. So the scope of the project is the construction of a big building whose final destination is to sell spaces on the free market or to rent part of the spaces on the free market. The idea for us is to figure out how the free cash flow of this venture will look like during every year of operation. Remember that in this case the special purpose vehicle has built the facility during the first part, so you have the building, and during operation you will rent this building to third parties. So if we have to figure out how the free cash flow of this project will look like, what would we include in the list of items in order to calculate the free cash flow? Which is the basic source of revenue from this piece of real estate? Which is the basic source of revenue? You have this piece of real estate and you must rent it. So the basic source of revenue is the renting fees of this facility. So plus renting fees Okay. Renting fees is the basic, the main component of revenues. Which are the costs that you will bear during the life cycle after the building has been built? Tell me. Any idea? You are the manager of the facility. You are the special purpose vehicle. And for a certain number of years, you will manage this building. So, which are the costs you will bear? And that you obviously will charge on the renting fees, for sure. Maintenance, for sure. And so, since the special purpose vehicle stipulates an operation and maintenance agreement, with this operation and maintenance agreement, I will define the cost that will be paid for maintenance, for lighting, for lifts, for cleaning services, and so on and so forth. Everything will be paid to the so-called facility manager, the operator, that will provide you services. So, minus cost of services for operation and maintenance, minus cost of services for operation and maintenance. Is it necessary for the special purpose vehicle to have employees? Not necessarily. If I pay a facility manager that provides me all the services that are necessary for the maintenance of the real estate, I do not need to hire employees. And in fact, special purpose vehicle uses the resources of the facility manager, for which the facility manager will be paid a fee. Okay? So think about the special purpose vehicle as an empty box, a shell company that has nothing inside. Everything is needed is purchased from the outside. Okay? So the cost of services, the personal costs, and everything is included into the fee for the operation and maintenance. Any other costs? Any other costs? You are the manager of this building. Suppose that you experience some damages because, I don't know, the lightning breaks down and there is a damage in terms of fire. Restructuring, what do you mean by restructuring? Oh, yeah. No, extraordinary maintenance. For example, there are some extraordinary works and you have to carry out it. And then, yes, why not? Cost for extraordinary maintenance. Costs for extraordinary maintenance. Good. What else? You have a building and you must, because banks requires you to do that. You must insure the building against fire, against damages, against third parties' liabilities. In Italian, third parties' liabilities is responsabilità civile. You have people working in the building and maybe there is some accident on those people. You have to insure them. And so you have premiums for insurance minus insurance premiums minus insurance premiums. Very obvious. And finally, an important, this is actually very close to the EBITDA of a functioning firm. It is operating revenues minus operating costs, excluding depreciation because we haven't taken into consideration the depreciation. So here, if we have a parallel with a corporate finance setting, we are more or less close to the EBITDA. But this morning, immediately after EBITDA, when calculating the free cash flow for a corporation, we included immediately after which item? Taxes. And in fact, if the project is able to generate revenues, we have to deduct taxes from the value of the EBITDA. And this is another difference between corporate finance and project finance, and in general all leverage transactions, minus taxes. This morning, we wrote down taxes on EBIT. Do you remember? And so we calculated only taxes on EBIT. In project finance, and for my students in the investment banking course when talking about the leverage buyout, once I told you one thing. Here we are talking about real money that is paid. And taxes are not calculated on EBIT in real world. Taxes are paid on the earning before taxes. Because I'm talking about real money that is spent by the special purpose vehicle. I'm not doing an exercise of company valuation here. I'm calculating how much cash is available. In a calculation of a corporate finance value of the firm, I calculate only taxes on EBIT because the tax on interest is included into the weighted average cost of capital. But I'm not doing an exercise of company valuation here. I'm simply saying, this is the money available and how much cash you have to spend. And the taxes are not taxes on EBIT. Taxes are taxes that are paid on earning before taxes. This is another big difference between corporate finance and project finance. So remember that taxes are full taxes, not ideal taxes. paid on EBIT. Taxes on earnings before taxes. I repeat, I'm not interested in calculating the value of the project. I'm interested in knowing how much cash is available after having paid all the costs. This is what I'm looking for, right? So taxes on earnings before taxes. Before taxes. What else must I include? This morning, after EBITDA minus taxes, we included what? Change in working capital. Can you tell me if in this case you have changes in working capital and why? Plus minus, according to the sign, change in working capital. Remember that we are talking about a real estate project. And the three basic components of working capital are inventories, accounts receivables, and accounts payable. Do I have inventories for a real estate project? No, negligible. A small amount of, consumption material, but nothing more. Why is it important to take into consideration working capital? Which are the, can I have accounts receivable or accounts payable here? And if yes, on what? Working capital is important because I don't know if renting fees are paid cash. Maybe renting fees are paid with a certain time delay, and this can create accounts receivable. So working capital can be referred, for example, to renting fees that are cashed in, not in cash, but after some period of time. Working capital can generate accounts payable because it is very likely that costs for O&M are not paid cash, but are paid after a certain period of time. And so there could be accounts receivables here and accounts payable here, and maybe also on extraordinary maintenance, and maybe also on insurance premiums. So changing working capital is important, actually. Once you have built the facility, do you have CapEx during operation? Because this is the final part? No. I have this facility, Bocconi is building this piece of real estate, and for a certain period of time, hopefully will not build up anything more. Okay? It is, I hope, sufficient for all of us. So CapEx is 0, and this is actually our unlevered free cash flow during operations. Unlevered free cash flow during operations. During operations. Question? Sufficiently clear for you? No CapEx. CapEx are, again, concentrated during the first part of the life of the project. Okay? Good. So, at the very end, we have more or less a clear picture of what is taking place in the first part of the project and what is taking place in the second part of the project. Now, what we must do is two things. We now know which items to include in our capital budgeting during construction, first part of our lecture this morning. We know what to include for every year of the operational phase, the free cash flow during operation. We now must analyze the second point that this morning I put on the whiteboard, which is the criteria based on which sponsors and lenders decide to participate to the transaction or to give up this idea and not to carry out this project. So, which are the criteria based on which sponsors and lenders decide, based on these cash flows, to finance the project or to give up the project and avoiding financing it? Okay? So, what we now must clarify is which are the criteria that sponsors and lenders use in order to evaluate whether a project finance can be financed or not. And essentially this is rather simple. Any question before going on? Any question? Sufficiently clear for all? Good. Two criteria, essentially. I anticipate you that the valuation by sponsor is very easy, while for banks the valuation is a little bit more complex, because we will require two conditions in order to give our approval for the funding of the project. For sponsors, the situation is rather simple. But before introducing these criteria, a first indications to you about the process that the financial advisor must go through in order to get the final approval for the signing of the agreement. Obviously, the idea is always the same. You are the project sponsors of the special purpose vehicle. You have given a mandate to an arranger to find money for your project. Okay? So the basic idea is, I have this idea, I call an arranger, I give him a mandate in order to organize the facility and to get the money that is necessary to fund the project. Obviously, the arranger works in the interest of this customer. And so, as a financial advisor, he will try to do his best, first of all, to accommodate the needs of the sponsors, for sure. The arranger set up the financial plan, and we will work on financial plans during the business game, and come out with a financial model that is useful in order to evaluate costs, revenues, cash inflows, cash outflows financial model. And this financial model, first of all, must satisfy the expectation of the sponsors, because otherwise the sponsor will say, if I'm not satisfied in terms of my criteria, I will give up the project and I will not do anything, right? So, essentially the idea is, the financial model must come out with, first step, I must verify if the criteria of acceptance for sponsors are met. Because the first counterparty that must be satisfied are sponsors. Otherwise, if they are not satisfied, they do not start the project at all. Okay? So the first counterparty that must be satisfied is the okay from sponsors. If the financial plan gives me numbers that are not satisfactory from the sponsor's point of view, the advisor has to repeat the exercise in order to find the proper solution, in order to get the approval from sponsors. Once the financial model is telling me that this criteria is verified, and in a moment I will tell you which criteria sponsor use in order to say, okay, it's fine, is to get the approval from the other big important counterparties, the banks. Because banks provide the larger proportion of funds. And so I must get the approval of sponsors. And so the project is viable. But then I must collect a sufficient amount of money from banks. And also banks must be in the position of saying, okay, this project is fine for me. So after the okay from sponsors, and if I have the okay from sponsor, I can move on and verify the second point, if there is the okay from banks. If, by chance, I can get the approval of sponsors, but banks are reluctant to finance the deal, this deal in this moment is not feasible. And again, the arranger must work again on the financial model in order to see if there is the possibility to improve the quality of this project in order to satisfy banks. If sponsors are telling me, okay, the project is fine for me, and banks say, okay, the sponsor is fine for me, then I can start the project, close the financing, and start the deal. This is essentially the time flow of the activity of the advisor. So the advisor will try to do his best in order to accommodate two conflicting interests interest from banks and interest from sponsors. Once you have tried many times to work on the financial model and find out a proper solution that accommodates both, okay, from that point on, the project is feasible. I can go in the syndication process and then close the financing and start up the deal. Okay? But I haven't solved your problem. When sponsors will say okay and when banks will say okay, based on which criteria do these two parts say okay, it's fine or not? From sponsors, there is nothing particular strange to say. The standard criteria that sponsors use in order to evaluate if the project is viable or not is internal rate of return from them. So it is a standard criteria that is used for any kind of project, also in a corporate finance setting. So the idea is sponsors will say okay if, given a certain threshold that they define for the project, the IRR for equity holders is higher than the threshold. For example, I will participate and I will provide money to this vehicle if at least I reach a 10% interest rate. If the internal rate for equity holders is 12%, sponsors can say, I'm fine and I will provide money. But if the financial models say the IRR for sponsors is 8% instead of 10, there is something that is not moving well. And so sponsors will say, no, based on these conditions, I'm not interested in financing the project. Okay? Sufficiently clear for you? Good. But what is the IRR for sponsors? I mean, which are the cash flows that must be included in the calculation of the IRR for sponsors during the life of the project? Sorry? Any suggestion? Which are the cash flows that must be included in the calculation of IRR if the position is the position of a sponsor? Sorry? Free cash flow to equity? Yes, but not necessarily. Yes, it is a good suggestion. It is a good suggestion. Any other idea? How many of you know the concept of free cash flow to equity? Raise your hands. Not all. Okay. Let's start from a simple situation. Suppose to be a sponsor, okay? And suppose you want to calculate the internal rate of return of your project throughout the life of the project itself. You start from time zero. Take again the example of this morning, the 6-year construction of your toll road. You remember this morning? We had 3 down payments at the end of year 2, and year 4, and then year 6. For the first 6 years, year 2, year 4, and year 6. During the construction phase, which are the relevant flows for equity holders? Yes, you are right, it's a free cash flow to equity, but in this case, free cash flow to equity is positive or negative? Is negative, and it is the contribution of equity that for every down payment I have to spend in order to finance the down payment of the contractor. And so, you remember this morning we had 1.2, 1.2, and 1.2, financed 50% equity and 50% debt. And so, we will have 3 disbursement, or if you want 3 equity contributions, each counting for 1/2 of 1.2 billion. Do you remember? It was 1 billion down payment plus 20% value added tax divided by 2 because the ratio was 1:1. Okay? So it is 1/2 of 1.2 billion each. 0.6 here, here, and here. Clear for all? You have to spend 3 times 0.6 because you are financing the build-up of the facility. Starting from year 6, hopefully, the facility will start up. And so, it will generate cash. Which is the cash that flows to the shareholders? Your colleague is suggesting free cash flow to equity, and I will give you now the idea. I'm not so sure that is free cash flow to equity, which is essentially the amount of cash that a shareholder can get from a project, whatever kind of project, also in corporate finance. Which is the remuneration of equity holders? Dividends. Remember, you are not in a situation where you have to evaluate a firm, where you can either use unlevered free cash flow to equity. You are exactly saying how much cash will flow to you. And free cash flow cannot be completely distributed. What is distributed is dividend, not free cash flow to equity. And I will show you why. Essentially, the idea is, if there are revenues and if there are costs, I will have a net income, and part of this net income will be distributed in terms of dividends. Okay? So, for all the years of the operational phase, we will have dividend payments. Dividend payments. But the observation of your colleague is important. So, close to dividend payments, I will write in parentheses free cash flow to equity, because I want to return on your point that is rather important. Dividend payments, parentheses, free cash flow to equity? Question mark? Look at the graph. In your opinion, the trend of dividends passing from the initial years of life, going through the end of the project, will be constant, will be decreasing, will be increasing, and why? My question is, based on your intuition, do you think that the trend of dividends distributed to sponsor will be constant, increasing, decreasing, and why? Please. Increasing, why?
Because at the beginning we have to pay back the cost that we had in the first part of the project.
Okay. And once the project goes on in its life, part of this cost will be repaid. There is one cost that is particularly important for us that will be completely repaid after a certain number of years. Which cost? Which cost? The cost of? The value added tax, for sure. What's more? The cost of the loan. The loan will be repaid in a number of years that is lower than the final life. If you have a loan which is repaid in 10 years and the project goes on for 25 years, for 15 years you will not have no more principal repayment and no more interest. After the 10th year, the cash flows for shareholders have a big jump because you don't have financial costs anymore. Okay? So the idea is that we have an increasing value of dividends, essentially for 2 reasons. The first one, because loan is repaid. And so most part of the costs that has been incurred in the first part are very likely to be repaid. In the final years of your project, it is very likely that most part of the cash will be repaid to shareholders because banks have already been swept away. Okay? Obviously, I'm not telling you what the internal rate of return is, but essentially, in finance, you know that the internal rate of return is the interest rate that makes equal the net present value of the negative flows with the net present value of the positive flows. So it is the interest rate that included in the formula of the NPV makes 0 the final result. Nothing different than in corporate finance. So you will have to discount to present the flow of dividends, and you must identify, so it is the present value of dividends year high calculated with a given IRR, and this present value must equal the present value of equity contribution for every year high, equity contribution, year high, discounted with this proper internal rate of return. Nothing new. If you want to have the formula, the standard formula is included in the handbook and also in your slides. But I don't want to tell you much story about this. Important for me is that you will remember the components of the internal rate of return calculation for sponsors. Contribution during the first part, proportional to the debt-equity ratio that has been selected. Dividend payments during the life of the project, as long as the project goes from the startup to the end of the project itself. Okay? Any question about this, guys? Clear for all? Good. Obviously, you know that IRR cannot be calculated manually, but if you have an Excel file, the Excel can calculate very easily the IRR equity. Simply provide the Excel file with the values that you need to calculate the internal rate of return itself. The question of free cash flow to equity, it is important because now we must shift from the calculation of the convenience for sponsors to the second step of our process to get the approval from banks. And before doing this, I want to calculate with you what your colleague talked about free cash flow to equity. That is rather important. In order to do that, we can use again the example of our piece of real estate. We stopped the analysis at the level of the unlevered free cash flow during operations, and now I want to continue this analysis asking you a simple question. And the question is very easy. This is the free cash flow during operation. Now, the question for you is, let's go on and let's move downward the distribution of unlevered free cash flow during operation. Okay? Remember that your project has received sources from the bank syndicate, subordinated debt, and equity. And so, what I'm asking you now is, let's start for every year of operation from the unlevered free cash flow. So, renting fees, minus cost of services, minus cost of extraordinary maintenance, insurance premiums, taxes, change in working capital. Now, suppose, hopefully, that this cash is positive. Otherwise, your project is in default. Okay? How can I use this unlevered free cash flow during the life of the project? I have already paid the cost for services, cost for maintenance, insurance premiums, taxes. Now, I can use unlevered free cash flow in order to pay who? In strict order. Senior debt. So the first part of the unlevered free cash flow will be used to repay, first, interest on senior debt, interest on senior, suppose not to have subordinated debt. So, to make things easier, after I have paid interest on senior, I can pay principal. I can repay part of the loan throughout the life. So interest on senior minus principal repayment minus principal. Let's call the sum of interest on senior and principal as debt service. Okay? So the service for every year of our loan. Debt service. Okay. You have paid also your lenders. Now you have available cash for you, right? So I have paid all the operating costs. I have paid all needed to return money to my lenders. What remains inside the special purpose vehicle is exactly what equity holders can get from the project. This is actually what your colleagues call free cash flow to equity, right? So it is free cash flow to equity. Under normal circumstances, free cash flow to equity should be paid back to the sponsors. And so sponsors could be allowed to appropriate free cash flow and get paid. But here there is another difference, and that's why I prefer to use dividends instead of free cash flows. For two reasons. First, it is very rare that in the first year of operation banks allow sponsors to keep for them all the free cash flow to equity. It is too risky. They prefer, in the very first year of operation, ask sponsor to set aside part of this fund in a cash reserve. Why? For unexpected circumstances. So, in the first, let's say, 3 years, I will ask that part of this free cash flow will be used in order to constitute what in technical terms is called debt reserve. So I ask sponsor to set aside part of the money in a cash reserve to cover unexpected events, particularly in the first year of operation. So minus provision to debt reserve, provision to debt reserve, usually, and I will show you when we will calculate this debt reserve is set based on a certain parameter. For example, I want you to set aside 3 months of debt service, or 6 months of debt service, or 1 year, if you are particularly conservative, right? Once you have set up the provision for debt reserve, you have no more the free cash flow to equity, but you have available cash flow to shareholders. Available cash flow for shareholders. Available cash. Available cash. Clear for all? Rather simple. The problem is, please. One minus t where? 1 minus t into the interest of senior debt. Here? Oh. Taxes? No. Sorry, I can't hear. When you took unlevered free cash flow, you subtracted interest of senior debt. Yeah. That interest into 1 minus t. Oh yes, interest on senior and principal means that. Oh yes, I know. Into 1 minus t. Interest into 1 minus t. It is unlevered free cash flow minus the interest on senior minus again principal. No, probably I'm not getting your answer. Your question. The question is.
I'm saying should we multiply the interest into 1 minus tax rate? Because
No. Oh, yeah. Okay, that's fine. He's saying, Professor, you told us that taxes are not taxes on EBIT, but they are taxes calculated on the earning before taxes. If you have calculated real taxes, you have already taken into consideration the value of interest on senior. And so, earning before taxes takes already into consideration the negative effect on earning before taxes. So, his question is, do I have to multiply interest 1 minus t times? The answer is absolutely no. If you have calculated full taxes above, interest rate must be calculated as the gross value and not the net value of interest. Otherwise, you double count the effect of taxes. I don't know if it is clear for you. Okay. Yeah, no, it is a times debt service. So, for example, if I have 3 debt service for the next 3 months or next 3 years, I will ask a provision of debt reserve until the debt reserve has reached that predefined amount. 3 years of debt service. You look at the financial plan, you look 3 years forward, how much is the debt service, and you must set aside funds until you have reached that amount of money. Right? Okay. Now, just to conclude on the free cash flow to equity. This is another difference between corporate finance and project finance. And this is a very tricky affair for sponsors. Look carefully and pay particular attention to this problem, because sometimes sponsors face a strange situation. And the situation is as such. I don't know in your legislations, again, it is a problem of legislation, but in Italy, you can distribute money to the shareholders only when. I repeat the question for Italians, and for not Italian, try to figure out is also your legislation has the same provision or not. In Italy, you can distribute cash to shareholders only when? Yes, debt are repaid for sure, but not necessarily. Otherwise, I would not see firms with debt pay dividends, for example. The idea is, I take dividends from? Yes. Suppose that the legal reserve has been set aside. From which I can take the dividend payment. I can pay dividend if the firm is recording a loss. No, because the civil code in Italy, but also maybe in your country, say that I can distribute dividends only if net income is positive. If there is a net income, the difference between revenues and costs, and this difference is positive, I can distribute dividends. If the net income is negative, I can't distribute anything, right? So, I will show you in one of in the next lecture, so next Friday, that there can be sometimes in project finance a strange situation where the available cash here is higher than net income. So, anytime this is a question, this is an answer for your question. There are times in project finance where the available cash, the bottom line of the cash flow, is higher than the net income. And this can be perfectly possible because net income is in the profit and loss and cash available in the financial statement. And the twos are reasoning in completely different ways. Here, you have simply the difference between cost and revenues. Revenues and costs. Here, you have more than revenues and costs. You have revenues, you have costs, you have change in working capital, you have debt service, you have more things. And so, sometimes, particularly in the very first years of operation, if I use free cash flow to equity, I'm calculating the cash available for shareholder in excess, because I can't distribute all of this cash if the net income is lower. Right? This is a very big problem for sponsors, because the problem is that if I look at cash, I see a lot of cash there. But if I look at the profit and loss, I see a lower amount of income. The bottom line is that cash is there, but I can't get back the cash from the special purpose vehicle because the net income is too low. Okay? This is why I prefer to use dividends instead of available cash, because sometimes available cash is available but cannot be distributed. This is what we will call, when talking about subordination, the so-called dividend trap. This is a dividend trap because I can't distribute all the money because net income is too low. And I will demonstrate to you that sometimes the profit and loss can record a loss, but cash is there. You have tons and tons and tons of money, but the net income is a loss. That money is completely unavailable for sponsors. You have cash, and unfortunately, you must keep the cash in the bank account of the special purpose vehicle. You can get this money back in terms of dividend, because net income is too low. Okay? Usually, in corporate finance, this does not happen. In project finance, this is a very common situation. And we will try, in the next lectures, to see how the dividend trap can be solved. Clear for all, guys? Any question? Remember, you can't distribute free cash flow to equity unless net income is higher than free cash flow to equity. If it is so, I can agree with you. Free cash flow to equity is the right flow. Okay? Good. What else? Nothing more. Just one more thing, very quick, and then we can stop. And we will continue the analysis next time. So we have clarified the perspective of sponsors. We have clarified the perspective of sponsors. Questions before to go on? Now let's have a look to the perspective of banks. Very quick, and without considering any additional things for today. I know that I have provided you with too much information, and I think we are rather tired. But I want to simply introduce what we will discuss next time. Banks must give me the okay. Guys, just a couple of minutes. I know that you are tired. Me too, I'm tired. Just to complete the picture. And we will return back on this topic later on next week. Perspective of banks. The perspective of banks is very similar to the perspective of sponsors. Because if sponsors require a satisfactory level of internal rate of return, also banks must compare the cost of funding with the internal rate of return. If I fund the operation at 5% and the internal rate of the deal is 7%, this is a convenient deal. But if I collect money to fund the project at 5% and the project returns me 4%, this operation is not feasible. And so, from the perspective of banks, the first test to be performed is to calculate the IRR for banks this time. We have calculated the IRR for sponsors, and we must now calculate the IRR for banks. What I call the IRR banks. I will show you next time how IRR banks can be calculated, but you can figure out very easily how it will be calculated. Drawdown of loans at the beginning, repayment of the loans during operation. But I will return on this point later. The problem is that IRR banks is not sufficient. So when sponsors are satisfied when the level of IRR has been reached, and so for them the only parameter that must be fulfilled is IRR, banks require one additional criteria, in a sense. IRR is simply an X%, let's say 5% per annum. But you know from your mathematical finance courses and your corporate finance courses that 5% can be a result that can come from a very different distribution of cash flows. I can get the same result with a very different combination of cash flows. The problem is that banks have stipulated with a special purpose vehicle a loan agreement according to which at the beginning of the project, they have signed an agreement according to which for every year or every semester this debt service must be compulsory paid. So the schedule of repayments cannot be changed because those payments are not discretionary. So the problem becomes that I ask for an internal rate of return, and this internal rate of return must be satisfactory. But on the other hand, I must require a second condition, that every year, for every year, where the loan must be repaid according to the original schedule, the cash available in the project must be strictly higher than the cash needed for the debt service. Please keep it in mind. IRR is important because it is the calculation of the return on the project. But there is an additional problem. If I have to be paid for every year of debt service, IRR is not telling me if in that year the amount of cash available in the project will be sufficient to pay capital and interest. Because 5% is 5%, and 5% can be generated by a very different distribution of cash flows. Banks require 5%, but in addition they ask one more strict condition. For every year where the loan must be paid, the cash generated by the project must be strictly higher than the debt service. Otherwise, there is no money to pay. Okay? I will explain you better next time. But in general, the second condition is what I must verify is for every year of debt repayment, the cash available in the project must be strictly higher than the debt service. There must be sufficient cash to pay the loan. If you don't have cash, you are bankrupt. Okay? And this has nothing to do with the calculation of IRR. Okay? So, for every year of debt repayment, the cash available must be strictly higher than the debt service. And this condition, Guy, is neither IRR calculation nor NPV calculation, because I'm not talking about present value of cash available, present value of debt service. I'm asking you for every year, point in time, if there is sufficient cash. And so this has nothing to do with IRR or NPV. And that's why we will next time see how to measure this inequality using, guys, and then I'm finished, one of the three families of covenants, the so-called financial covenants, because this condition is measured by the so-called cover ratios, what we have seen before. So in order to calculate this inequality, we will make use of cover ratios. So in order to get approval from banks, you must satisfy two things: a minimum level of internal rate of return and a satisfactory level of debt service, and a satisfactory level of cover ratios. Okay? So I stop now. I thank you for your attention. Have a good weekend and see you next time. Bye-bye. I'm available for questions.